Atul Suri, Marathon Trends. Well, he's back and let's connect with him. Good morning. So nice to have you back. I kept the studio chair empty hoping you would join us live in our studio with that yellow sheet of yours with the red pen. Now the seat is
I'm
empty.
sorry. Next time, promise.
Okay, look forward to it. Look forward to it.
Yeah.
Markets are looking slightly jammed and global volatility has kicked in. Are we in for a volatile and a tough second half of this calendar year?
Nico, actually, I think that it's human nature to be worried about things. And I feel the market is, you can see the markets yesterday, what happened in the US, down 600 points on the same data, close 100, 200 points higher. So the thing is that when I look at a bigger picture, I feel that the world is in a Goldilocks scenario. So what really happens is there are four asset classes. So if you look at first commodities, you'll find that one of the biggest problems the world had 2 years ago was about inflation. But the way the commodities have taken a back seat and correcting. So the issue of inflation for the moment, thanks to cooling commodity prices, is pretty much rested. Linked to that is bond yields because as commodity prices and inflation goes up, interest rates went up. We saw that in 21, 22, 23. And you'll find that even there is a talk about now the Fed cutting. So the second quadrant, which even debt or bond yields are on a quieter phase. The third area is about currencies. Again, you'll find that globally there's no major upheaval as far as currency grows. In fact, the DXY is near 100, which also is where it should be. And the fourth quadrant, which matters to all of us, is equities. And equities is at lifetime highs. So if you ask me if I take a step back, and I'm not talking about the day-to-day volatility or week to week, but the fact is that globally, as each asset class should be positioned, I think it's positioned there. It's what is termed as a Goldilocks scenario, where there's growth but no hyperinflation. And I feel that we're in a very, very sweet spot. Yes, things will change. The Fed comes in, there's data every day. But overall, I mean, there is nothing, there's no real big red flag. Day to day, things will happen. One whip here, one whip there. Markets move 500, 700,000 points. Yeah, they do. Markets are never static. But in the larger scheme of things, Nikunj, I think the world is in a Goldilocks scenario. And for equities, the asset class that matters to us, all the major global markets or markets that matter are a few percentage from lifetime highs if they're not already there.
All is well. But Atul, hi, morning. Let's pick up on those four indicators that you talked about, right? And I want to first talk about commodities. The fact that copper is at a 16-month low and, some say in bear market as well, is that not a red flag enough?
Aisha, if you look at copper, you'll find that in the last few months, copper had really spiked. In fact, it had gone and made a new breakout levels. So from that point of view, copper is just cooling some of the excesses it made a month or two higher, 2 or 3 months earlier. So that is something which I feel is really playing out. The commodity that really concerns India is crude. And if you find Brent at 70, 71, where it is positioned right now, I think for Indian markets per se, and even the globe as a whole, yeah, these are very, very healthy signs. Yes, commodities should not crack. They should not be, like get decimated because that signifies that, well, there is a problem with the economic recovery or economic growth, that there is a demand issue. But a lot of these commodities are corrected because what happened was we went through a very abnormal time post-COVID where they had crashed at COVID time because demand got hammered and then they spiked. In fact, the CRB index went up 3x from I think 100 to 300 or thereabouts. So right now it has come back to something like 250, 260. I think it's good. It has to kind of rest. And more importantly, if it stays within a range for a elongated period of time, I think that's very, very healthy because this was a very big issue for corporates worldwide and for markets. So cooling commodities, that's where I started. Very, very healthy because it puts to rest that whole inflation issue, which caused a big problem globally.
Right, Atul, so let's talk about themes which we've discussed in the past. The leadership in the market was with cyclicals, defense, perhaps shipyard, and even railway names. A lot of those stocks have corrected. And it's quite ugly if I look at railways and even in shipyard companies. 15 to 20% is the correction. Is the bull market still intact in those stocks, or is our happy hours over?
What was really happening is, Nikunj, in the last 1 to 2 months, more so post elections, you'll find that there's a dramatic shift happening thematically. The risk on trade, which were the industrials, were some of your PSU banks for that matter. PSU banks were the best performing sector for 2 years back to back. Defense stocks, etc. They have all actually cooled off. I'm not saying that they have cracked, because if you look at the move has been 200, 300% from where they moved. And yes, if they've corrected 10, 20%, I think it's normal. These things had run up, they were excesses. And what I feel is that they are just cooling off. The trend has not broken. I still feel that this bull market, which is a multi-year run, is going to be led by industrials. However, there is a need for the rest of the market to also catch up. And the world is moving towards a defensive scenario in terms of the Fed, in terms of all that, so much narratives that are coming. You can see even in our domestic market, you will find that three sectors that stand out is IT, second is pharma, and third is FMCG. And you'll find that these sectors have done well. These also sectors were actually underperformers for 2 years prior to that. So what I feel is that the rest of the market is catching up. So I think it's someone who's run needs to rest. The market or the sectors that were lagging are catching up. So you rightly put, I think the question is very relevant, that I feel that the themes or the trends are changing. However, what led this in the last 1 to 2 years is not over. It's just resting. It may take a few months, a few quarters, but that's great, because what happens by this playing out, the market breadth improves. You can't have just industrials leading the complete bull market. And a lot of these so-called quality stocks did nothing, nothing. They were an absolute no gainer for 2 years. But now you will find that they catch up. And then once they catch up, then we actually get set for the next leg of the market. So I'm very bullish, the market as a whole. And there is a sector rotation happening right now, which really is the issue that I grapple with on a day-to-day basis. The issue is not about being in cash or being invested. I am fully invested. The issue is that the overweight in industrials and PSUs and defense has to now tilt slightly to IT, pharma, and FMCG.
And how much would that weightage be? So let's say in April, what was your weightage towards industrial cyclicals and PSU? How much is it now? And what to your mind should be the ideal mix of FMCG versus pharma versus IT and industrials?
We had almost reached about 60 to 65% in industrials. That includes your PSUs, it includes some of your defense stocks. And now we've been able to clip off a good 15%. And our weightage has increased dramatically to pharma. We feel that pharma is one sector that has been ignored for many, many years. And there's a lot of improvement in their performance, in the overall. They've been able to, clean up the house for them. And we feel that pharma is actually getting poised for a very, very big up move. So we find a major allocation has gone into pharma and FMCG. I also get a sense by looking at the market that the whole rural theme is playing out. You can also see it between four-wheelers to two-wheelers, that the government post elections has had a bit of a reality check, and they feel the need that there is rural distress. They need to remedy that. So the feeling is that a lot more money is going to flow in there. Plus, we've had a fantastic monsoon. So you're having record sowing. So the output is that you may have an excellent, excellent harvest. So I do think that the market is moving towards the rural driven themes. That is why, when we talk of FMCG and stuff like that, you will find that they're doing very well. Some of the fertilizer stocks are doing very well. So I feel the market's moving on a bigger play from a risk on to a bit of a risk off mode.
That you're getting when it comes to the entire BFSI sector then, Atul?
Yeah, so I find that what the banks are losing out to is that the whole NBFCs and BFSI sectors gaining, because banks were dominating a lot many places, not only just the lending space, but even the AMC and broking and insurance and etc. etc. But what has emerged is a very strong tech-driven NBFCs or the BFSI place. And what they're doing is taking away the chunk. So that is why you find that private sector banks is a sector or a theme we've been underweight for more than 2.5, 3 years. But the flip side is that the benefits are coming to these other plays. So you look at AMC stocks, you look at broking stock, you look at insurance stocks right now. You see the kind of response that the Bajaj IPO has kind of garnished. So I feel that there is tremendous amount of interest outside the banking space. And I think that is again very important because the market is broadening, the sectors are broadening, the themes that are playing out a lot more. And this is very important because this makes the longer term trend much more solid and robust.
And I recall, Atul, chatting with you about this, I think in June as well, when you made the point when, the Nifty Bank gave sort of a false start that you just don't see that move coming in for banks at all. So do you think with this entire, shift which is happening within sectors where the index is going to stay put, the Nifty Bank will continue to underperform?
See, every sector will have its day in the sun. But at the moment, honestly, we are not seeing early signs of that. Just as we are talking about pharma and IT, probably we were not talking about them 6 months ago. So the themes or the trends will keep changing, and that's the name of the game. That's our job actually as fund managers to be able to kind of navigate portfolios through these trends. But at the moment, yes, the big challenge is in the bank Nifty. But as I said, sooner than later, even that will have its time in the sun. And as and when that happens, we have to be quick enough to rotate into that sector. But the thing that really stands out for me at the moment, or the things that I'm working on, which takes up my time, is essentially the allocations to pharma, IT, and FMCG, and identifying stocks in that place.
In fact, the FMCG index has hit an all-time high, Atul. It's happened after a gap of what, 3-4 years maybe? Almost 3-4
Sorry,
years?
which stock? Which
FMCG
stock was
index
it?
has hit an all-time
Yeah,
high. It's happened
yeah.
after 3-4 years.
Yeah, and you can see, the things. Remember, we used to talk about these quality stocks, this whole quality thing. This whole quality stocks have not done well for 2 to 3 years. And now they're getting their place back. They're getting their mojo back. And rightly so, because you cannot ignore these high quality companies. So it's, you'll find the paint stocks, you'll find the FMCG stocks. So all these guys were actually underperforming for 2.5, 3 years. And the whole rotation is happening. So even as funds, you realize that this whole flux that would happen to thematic funds, which were defense fund and industrial fund and infra fund. And very often, whenever a lot of thematic funds come in a certain theme or sector, things get a little toppy. And you'll exactly see, I mean, who was coming out with an FMCG fund or who was coming out with a pharma fund. But themes change, trends change, and as allocators or as fund managers, our skill set is ultimately to be able to align the portfolios or to navigate these trends. And clearly, I see, as I said, what keeps me thinking, what keeps me doing research are how these new themes and trends are happening. And mind you, these themes and trends don't play out for 1 week, 1 month, 3 months. These are tend to be a 2 to 3 year kind of play. And after almost 2 to 3 years, I'm seeing a very big shift that is playing out.
Recap what we've discussed. You still feel that the leadership lies with industrials and cyclicals. Within that, FMCG and defensives are catching up. So shift a little bit of allocation from industrials to FMCG and other sectors, but keep that as the large overweight. Still, that should be the heart
Yes.
of your portfolio or core of your portfolio.
Yeah, I mean, I totally agree with that because I personally think that the bigger story is still going to be playing out in industrials. They have run up hard. They need to rest. They need to rest because if they don't rest, then things go crazy. Like you look at some of the defense stocks as to what was happening about a month or 2 months ago. You could not sustain. You cannot sustain that kind of move in such big companies, such big cap plays. So it is rightly so that they have corrected. They will rest. They will spend some time till people start ignoring them and they start writing them off. And when that happens, I guess then the time is there for them to make the next move.
Now, Atul, do you see a sustained leadership come in for IT, FMCG, and pharma?
Yeah, I do think so. I do think so, Aisha, because these tend to be very secular and thematic. As I said, we've lost trusted them because of the last 2 to 3 years of performance. But you got to go back from 2015 to 2020, or when it was the so-called quality, especially in the year 18, 19, 20. You'll find that these also can move very fast. They also are great sectors to be in. It's just that the market has its way, when the pendulum swings on one side and you feel it's going to go on till infinity, it again pulls the other side. So these sectors are great sectors with a lot of great companies. Fortunately, a lot of stocks listed in them, and there's a lot of quality to hunt, which is very very good.
Atul, how should one look at these new tech stocks now? I mean, they've also made they've also demonstrated exceptional strength. Let's say Zomato, even Paytm, Policy Bazaar. There are no historical reference points here. So how should one look at that sector?
Absolutely. I mean, I totally agree with you that, in terms of valuation plays, you can't put the same matrix for these companies because the growth in them is parabolic. For me personally, I just still I feel that markets are slaves of earnings. Some stocks which are going up due to earnings, I think are some things that I would back and bet because I'm very, very wary or scared of just a theme moves and stories. A lot of stories come up, and very often you get into them, and when the thing turns, you get really whacked. So I find that even in this digital space, which I think is extremely, extremely interesting, those companies that are able to deliver and there is a certain amount of clarity, I feel are going to still, make a lot of money. A lot of people feel, oh, they've moved up, they've doubled or trebled. But I feel that these are stories which are 10x stories. And when profit comes, I mean, I've seen that whether you studied Apple or Amazon or Tesla globally, all these high tech spaces, you'll find that when profitability kicks in, that's when the joy is. And most people get very limited in their abilities, but these things grow exponentially. And I do think that there are some plays in India for sure.
Atul, what is it that you're making of autos? Because, much like what's happening within various sectors, and you talked about industrials versus IT, FMCG, pharma, within autos also there is another story altogether which is playing out where the two-wheelers are doing something else and, the CVs and the PVs are up to a different story altogether.
I agree with you, Aisha. That's very true. It's very visible. Whole divergent trend, like what happened to telco yesterday. And on the other side, a lot of these two-wheelers are making new lifetime highs. So I feel that that rural theme that I said is also going to be playing out very strongly in this area because this sector is very dependent on rural demand and the kind of contours that emerge from there. And as I said, that one thing I'm getting very bullish about is the revival in rural demand. As I said, that I can see the government clearly pushing a lot more money. As I said, they've learned a lot from the election outcomes, hopefully. And number two is that we are going to have a record harvest. With that as a background, I think that rural consumption will kick in. And that's why you'll find that there is a divergence of trend within the auto sector. Whatever is more rural facing will do well. What is urban will kind of rest.
So Atul, let's wrap it up with one final question. We tend to make this as the last question always, which is that the short-term market outlook or short-term, what do you think will outperform? When I say short-term, 3 to 6 months, medium-term, 1 year, long-term, anywhere between 3 to 5 years. If you have to, let's say, identify one name, one asset class, one idea, short-term, medium-term, long-term, how would you fill in the blanks?
So first of all, let's come to the index itself, because right now everyone feels, oh my God, the market's going to correct. Correction to hoga, yeah. That's a part of the game. But my target for the Nifty is around 26,400, which is a good 6 to 7%. So at the moment, I will not be fretting too much about allocation or taking money off the table. There's a lot of angst about that. As far as the sector, I think that, as I mentioned, that we are at least going overweight pharma, and that would be my sectorial pick for the coming few months. But as far as the 3 to 5 year story, I still feel that industrials will dominate. But in short term, there are a lot of places where there is undervaluation, which needs to be catching up. So I think there are going to be a lot of opportunities. I am really not too bearish on the market. I think globally, as I said, I started my first term, the world is in a bit of a Goldilocks scenario. Worries are important. People should panic. That is very important because when that doesn't happen, then the markets crash. So all the worry, all the panic is good, but I would still continue to remain bullish. And as I said, I would bet on IT, pharma, and FMCG for the 3 to 6 month time frame.
Okay. Appreciate your time, Atul Suri. And I shall reserve the chair.
Sure.
Next time.
Done deal.
Next
Done deal,
time
bro.
in our office.
Done deal.
Thank you very much.
Thanks. Bye. Bye.
Well, Vinayak Chatterjee.
If you like this video, then like, share and subscribe to ET Now.